excited today to geek out with Lisa Fleck. For those of you who don't know Lisa, you should. And if you don't know Lisa, tell us a little bit about your background in mortgage and lending. And then everybody, we're going to geek out on this a little bit because the mortgage industry, it seems like we're getting every single day updates of what's changing and what's happening with appraisals. And then we're hearing about loan interest rates. And then the Fed is cutting rates to 0%. And so how does that affect mortgage rates? And
lots of questions, right? Lots of information, lots of questions. Yeah.
Lots of people have questions. It seems like it's changing every day. So Lisa, let's just start off with who are you? How long have you been in the industry for people who don't know you?
Okay. Well, my name's Lisa Fleck. Been in the industry in Reno for about 20 years. I am a producing branch manager for Fairway, a new branch that's opening up. So we are all, of course, currently, living with the being safe in place situation, right? So, been in the business for 20 years, survived the last fun roller coaster ride in the mortgage industry. And when this started literally 23 days ago, was like, it's not going to be that big a deal. It's just a little hiccup. And of course, it's changed into being this very large, all-encompassing type of a situation. So I'm looking at this from the standpoint of I survived last time, and we're all going to survive this too. And it's just a matter of kind of changing that mindset and knowing how to kind of get yourself hunkered down and take advantage of perhaps maybe some of the extra time that we have, that we can maybe kind of refine our businesses and then, because this will end and it's going to end a lot faster. And I think there's a lot of positive things that have happened that will support the real estate industry. But for the next, 30, 60, 90 days, it's going to be kind of a interesting time. So, kind of going through it and moving from that standpoint.
So, excuse me, you alluded to, you made it through last time. So I assume what you're saying is that you made it through the crash of the 2008, 9, 10, 11, right?
Right.
So is there anything to you that's similar about that time to this time?
I think there's been a lot of really encouraging things, and I'm excited about some of the things that the government has done. And I honestly don't know that they would have been ready to pull the trigger the way that they did in regards to providing support, creating that stimulus package in such a quick manner, if they hadn't experienced 2008, right? So I think that kind of crept up on everybody and no one knew what to do. And there was a lot of blaming, oh, well, it's the appraiser's fault or it's the hedge fund's fault, or, no one wanted to take responsibility. And so it was one of those things that kind of no one took responsibility and everyone kind of blamed each other. And so they all stepped back. And as a result, we ended up kind of, just having everything kind of crash. What my takeaway is from the stimulus package is that the federal government stepped in and said, hey, this is no one's fault. Economists had said we were going to kind of be heading into a recession anyway, but then this came on top of it and just whammed everybody, and globally. Understand it's a global situation. And so what they've done with the stimulus package that I really feel is going to sustain real estate, and we're not going to see the massive foreclosures that we saw last time, is because of what they've put into place. Now that has interestingly caused repercussions that were unexpected in the mortgage industry itself. So the mortgage industry is struggling with some things in the last 10 days that, it's like, yay, rates are really low, we're going to be super busy. And it's like, oh my gosh, what they did in the stimulus package created a whole bunch of other things that have become consequences that they didn't anticipate. Great news is that there's a lot of super smart people in our industry, and the federal government is also listening to the mortgage side at this point in time. So they're trying to really work on finding the balance of taking care of people whose lives are impacted by this on a temporary basis, and then also taking care of the mortgage industry so that it still exists in 60 days.
So what are some of the things that we just didn't anticipate happening? What is going in the mortgage
Yeah,
industry.
so I think probably the one thing that most people have questions about right now is the forbearance question, about the fact that they are allowed to go ahead and skip payments and really there is very little required documentation in regards to that. You basically call your servicer, you say that my life has been impacted by COVID-19, and they will work with you in regards to forbearance. And what that is in addition to the moratorium of not filing any foreclosure proceedings for the next 60 days on any kind of a loan, forbearance is about working with your servicer so that you don't have to make your mortgage payment. Now, there are unintended consequences. So the way that I kind of look at this from an analogy is, it's fantastic that there's this safety net for people that truly need this, right? If you truly cannot make your mortgage payment, then take advantage of this, which is awesome. And I'm so glad that it's there because it's going to keep real estate values up, because we don't want to glut the market with foreclosures. We don't want that to happen. The banks don't want to own the properties. They're just getting the stuff off their books from last time, right? I mean, they're just finishing that up. They don't want to go down this road again. So I think it's a super powerful tool. But what I like to equate it with to my clients who are calling me and saying, oh, I heard I could skip a mortgage payment. And it's like, well, yes, technically you can, but let's talk about this for a second. It's kind of like a vacation. So you kind of go, oh, I can go on vacation, right? But vacations cost money. And no one knows, nor has anyone really determined what that's going to look like on the back end. Right?
Because your payment's not being forgiven.
Right, exactly. So I've heard that people have called their servicing companies and they say, yes, you can skip 3 mortgage payments, but then at month 4, you owe us for all 3 mortgage payments. That doesn't really help anybody, right? There's been talk about you'll do a loan modification when you're done and they'll simply add those payments to the end of the loan. But right now, again, it's like, that's back-end solutions that have not been defined. So what I'm sharing with my clients is, if this is something that you truly are struggling to do, I don't want you to lose your home. You need to take advantage of this wonderful opportunity. But if you can continue to make your mortgage payment, if you haven't lost your job, you have the capacity to work at home like we do, then there's no reason for you to take advantage of that, because we really don't know how that's going to play out. They say that it's not going to impact your credit scores, but last time I checked, the credit reporting agencies aren't that accurate at times, right? So try to get 3 missed mortgage payments off your credit report. That's going to be a little bit of a problem. Let's say 3 months down the road, something does happen and you're still working, but you now need to take a cash out refinance or something like that to keep things moving. If you have chosen to be in forbearance for 3 months, they're not going to give you a new loan. So you're really restricting your ability to manage your home if you need to. So there's a lot of unintended consequences that could potentially be a problem if you do that. Here is how this is playing out in the mortgage industry. Because of this wonderful safety net that the government created, which needed to be there so that people could, get through this, because it is a much more of a limited time type of a situation. What happens is that, just very simplified, is that when we lock a loan, we are promising to provide that loan to an investor at a certain period of time. During that process, we and I say we, but the industry has margin calls. And so what's been happening is that all of these margin calls have been coming in for the lenders. And so lenders are paying out millions and millions of dollars on these margin calls. And no one wants to buy mortgage-backed securities right now, because no one knows if that person that they're doing the loan for is actually going to make that mortgage payment. Mm-hmm. Then you also have first payment defaults, which technically is a triggering event in your deed of trust that says if you don't make your first payment, they can call the note due and payable in full. Mm-hmm. So there's a lot of things that, doing this thing up front, which they really needed to do to keep the real estate market balanced, has a lot of unintended consequences on the back end for lenders who are dealing with margin calls, who are dealing with investors who don't want to buy our product because they don't know if the person's going to make that payment. The servicer that you make your payment to, they still have to pay Fannie or Freddie, whether you make your payment or not. So, and then you also have people who have been refinancing their homes. So there's a cost to early loan payoffs, things like that. So all of this is going on in the back end while we're trying to help support people on the front end and manage all of that. So it's a dicey game. It's kind of crazy right now.
So what's practical? What can a agent out there, a real estate agent out there, what is practical for them to be counseling their clients about? I would imagine that your closing in 3 weeks or 30 days may not be as easy, because not only do you have what you just explained, but you may have some appraisal hiccups, right, or some slowdown there. What advice should we be giving clients right now?
So right now, with purchases, we are getting them closed. Most lenders are getting them closed as quickly as possible. One of the things that I'm recommending to the agents I work with is see if we can get a 45-day escrow. Not that the loan won't be done in time, but it gives us flexibility in regards to appraisal turn times, because we're having appraisers who are refusing to go into homes. Now, Fannie came out, and I didn't have a chance to confirm this, but Fannie came out, I believe this morning, and started talking about the fact that for purchases, they're just going to do drive-by appraisals and call it good. Now, that's a problem as an agent when you have a home that's been completely remodeled in a neighborhood that is not, and you have priced that home to reflect the seller's investment, right? Yeah. That appraiser is not going into the home to see what that is. So being prepared to still communicate, working through the lender, still communicate with the appraiser in regards to, you pull the listings, you pull the pictures, you provide that additional data. If you feel that you've got a home that is perhaps maybe priced higher in that neighborhood because of everything that seller invested in the home. So that's an important piece. FHA has not gone to that point yet. VA has not gone to that point yet. They're still doing in-home appraisals, full appraisals. What we're also finding is that a lot of appraisers simply are refusing to go into the home. And we're also seeing a lot of appraisers charging more to go into the home because there is a risk. I mean, let's be completely honest. It's an appraisal and it's a risk of my health. So, what I'm finding is appraisers are saying, hey, I want the person there on the property, but are they willing to leave the home so I can go into the home? They have to stay on property. But I can then go into the home. I don't want anyone following me around. I want to come in. I want to do what I need to do, and I want to get out. Yeah. And so it's kind of like, it's kind of the new norm. I kind of think the new normal is really thinking outside the box in every single possible situation that we're dealing with at this point in time. So from that standpoint, I think the appraisal piece is getting loosened up a little bit. It can backfire on you if you really feel that your pricing needs to be supported with an interior inspection. So that's a way that they could definitely help their clients from that standpoint.
And then didn't this get extra dicey? So here we are geeking out. And if anybody has questions, please type them in the comments below. We can see them. Didn't the whole appraisal situation get a little dicey when you had an influx of refis? Yeah. Right? Because right, you had one of the largest times to refi this month, right? Or at the beginning of the month with some of the lowest rates. Then you have people who are trying to make purchases or intending to purchase, and you have COVID-19.
Yeah, so it's been the perfect storm of insanity. I'll tell you, it definitely has. What we're finding more and more if we're doing refinances is we're doing everything that we can to get those property inspection waivers, and Fannie and Freddie have released or minimized they've made it more open. They're not nearly as restrictive. So we're working on that standpoint. So we're not having to have an appraisal. That if it had a Fannie or Freddie loan on it before, then oftentimes I can get those property inspection waivers. If you're taking cash out, maybe not so much, but if we're doing a rate and term refinance or reducing terms or something like that, that's helping some. But to your point, Jared, we were talking, I remember an appraiser usually gets like maybe 10 orders per week.
Yeah.
During the time when everyone was locking, they were getting 10 orders per day. And these people work really, really hard as an independent contractor by themselves. So not only are they going out, they are then having to come back and write these reports. And they just got to the point where they just like, we just don't have any more bandwidth and capacity. Right.
Because, I mean, you explained it really well, everything that goes into the appraisal, right? So you have comps that you have to pull, you have comparables that you have to pull, you have to go into the home. So it's not like this easy that they can just push a button and get it done. They've got a lot of physical work that they have to do.
Yeah, it's very involved. And I don't think that it necessarily feels that way to them or to the client who's there, to the seller or the agent sometimes, because they're really only at the property for 15 minutes. Understanding that there's 3, 4, 5 hours of research and stuff that they're doing at the house, at their desk, that for each appraisal. And so you take that and you multiply that by 10 a week. Well, that's still a lot of hours. It's 40 to 50 hours a week. Well, now you're talking about 10 a day.
Yeah.
There just isn't time. And it's, we're kind of experiencing the same thing on the lending side as well. We have all these, it's great. You think you have all this business and it's awesome and it's wonderful. You have underwriters that are working 60, 70 hours a week trying to keep up. And then of course, then endangers their health because you become stressed and you get tired. One of the other things I think that's a consequence that I think it's really important, I want to touch on with the realtors is that if they have clients that are pre-approved, it is vitally important to stay in contact with their lender, because what's happening is as our channels of companies and investors starts to dry up because they simply don't want to be purchasing these what they're seeing as very high risk investments at this point in time because of, gosh, we don't even know if they're going to make the payment, right? Because they can do that and be protected. Is that we are beginning to see every single lender in the country putting overlays back on their loans. So I know for us,
it's I mean, where it was relatively easy, right? Or they removed a lot of those overlays over the years. Now they're looking at it and going, we're taking it back.
Right. And they're temporary. The industry is being very clear about this. This is not, we really firmly believe there's a lot of great people, a lot of super smart people who are working with the Fed and who are working with lawmakers to understand the unintended consequences of what happened, and fix that. There needs to be help and support for the mortgage companies as well, so that then they can continue to keep those warehouse lines open and they can continue. Because what we're seeing is like, it used to be that you do it within 10 days of closing, you do a verbal verification of employment. No big deal. We're now doing one at 7 days. We're doing one at 3 days. And there are actually investors coming back to us on bond loans that are having us do verbal verifications of employment after the loan closes. And if that person is no longer employed, we can't sell them the loan.
Yeah. Wow.
Yeah.
So then what? Are you sitting on that loan?
They're going to have to sit on the loan. They have to keep it on their warehouse line. And if they keep it on the warehouse line, then that reduces the capacity to fund that next loan. Yeah. So we're seeing temporary overlays. Some lenders may not have put them into place yet, but honestly, it's only a matter of time. So again, my recommendation to the real estate agents is to stay in really good contact with your people that are out there buying, because there are people out there buying. Like I just got 3 purchase contracts over the weekend, and I'm super excited for my clients. They're getting fantastic interest rates. They're getting great deals on homes. These are well-deserving families. But, these overlays are going to come in, and there's not a single lender that isn't going to be doing them eventually at some point in time if they want to stay in business, is really unfortunately where it's going to be at this point in time. And so you may have someone that was approved at a 620 on an FHA that may no longer be approved because of these temporary overlays. So that communication is going to be vitally important with the lender.
So 2 questions on in the comments. Thanks, guys. Chris Smith asks, what is happening with the jumbo market? Is it possible for buyers to still get a jumbo loan? And then somebody else, I can't see the name, but just asked, what are your thoughts on jumbo loans? I hear some loan originators are still doing them. However, many have done away with them altogether.
Yeah. From a standpoint, so I'm a private mortgage bank. So we use we have usually like 10 different jumbo loan options. We basically don't have them right now because what's been happening, I've actually heard of this, and this also goes for non-QM. And basically non-QM is the definition for anything that is not Fannie, Freddie, Govy, right? So that would be your bank statement loans. This would be your asset depletion loans. This would be some of the stuff that was starting to come back. Very small percentage of the market already, but it was growing, but this was more of the stuff that was kind of, we lost back from 2006, still, again, some viable products for people. There is no QM lending right now because there is no one to buy the paper. I have heard of people in jumbo loans where they actually had signed their loan docs and they were supposed to fund, and the next morning the company said, no, we're not funding loans anymore. Because again, there is no federal assistance for those loans. So you're basically talking about the Fed is helping out this MBS securities, and jumbo and QM or non-QM are out here. So if you're doing a jumbo loan, my recommendation really honestly is to go with an FDIC insured bank. Make sure you have a 60-day close of escrow and have your client understand that at the end of that 60 days, they may, I don't know what they're going to do. I can't speak for the banks, but if things continue down the path, there is a possibility that that may fall out. The other option is that you do a conforming first and a second. So you do your 5, 10, 400 and you get a second. And then when everything kind of settles down, because you have used that second as a purchase money second, you can, when that jumbo warehouse or those jumbo lines open up again, because I believe that they will, it's just going to be a matter of time. Then what you can do is it's actually considered a rate and term refinance, because the purchase money second was not considered a cash out. So you have a first and a second, you consolidate them into your new jumbo loan amount when that line, it becomes readily available again. And then you don't have to have that hit of that cash out. So that would be a strategy that I would put in play. It's, it dependent on each person's situation. Are you comfortable having $200,000 on a line of credit? These are the different types of things.
Right. So another question, have you seen investors backing out of funding on permanent manufactured homes?
I haven't yet. It's a higher risk. I would expect to see, honestly, I would expect to see overlays come out. Like you have to have a 680 credit score to do a manufactured home. It's that type of thing. And the crazy thing is it's really not credits. It really shouldn't be credit score driven, because you could have a 780 credit score and but you work in an environment where you lose your job. It doesn't matter what your credit score is. It's like, can you make your payment? Right. But you can't under Fair Equal Credit Opportunity Act, you can't do it that way. You have to go with credit scores. So again, it's kind of a combination. One of the things that we've started doing is when we're sitting down and pre-qualifying clients, having that tough conversation up front. So, what is your current situation? When I'm doing my refis, like, what is it that you're doing? What is the probability of you still having a job in 50 to 60 days? Let's have a conversation with your employer. So we're working on finding ways around that. Like I've gotten furlough letters from employers that basically say the only reason our business is closed because we've been ordered as non-essential. When this is passed, which it will, then the client is coming back to work at their same rate of pay. Mm-hmm. And so that's really the key phrase in that letter that needs to be there, that they will be coming back to work for us and they will be coming back at the same rate of pay. Then we include that letter into the closing package or into the underwriter. And then it's dependent on the underwriter. It's dependent on the company policy. It's going to be hit or miss either way from that standpoint, but we're seeing that helps.
And this is changing. Like one of the things that we joked about last week and today was this is changing all the time.
Yeah.
You have something that you were told this morning could be different tomorrow, could be different right now, right?
Absolutely.
how are you and how's the rest of the industry? I mean, how are you staying up on all of this? And then could it come to a point where you believe you have all of your ducks in a row and then something changed and now my buyer can't buy? I mean, you have heard of that happening?
I have heard of that happening. In fact, one of my contracts, I spoke to the listing agent and he didn't really care what loan type I was doing. All he cared about was what the person did for a living.
Yeah.
Right. Is he still going to have a job? And so, it's one of those situations like, well, he's approved right now and we're doing all of our due diligence and we're going to, my feeling from what I've talked to my client about is that we should not have a problem. But it's the word should. It's not, I can't speak to an employer and what they're going to have to deal with. Right. So what am I doing to stay abreast? It is literally like, I can't believe that we really had lunch like 3 weeks ago and this was like nothing. Right. And it's like, oh my gosh, it's crazy. So what I'm doing, so and there's a number of really great loan officers in our area that also I subscribe to MBS Highway with Barry Habib, and I also subscribe to MBS Live. So I have 2 subscription services that I'm using to try to stay on top of that. And in addition to that, I am very blessed to be part of a coaching group that is literally some of the top minds in the industry. And we have every Saturday afternoon, we have happy hour, which gets to be kind of interesting. All of us from all over the country, we're on a Zoom call together. And these are people that are capital market people, secondary people. They're talking to Fannie, they're talking to Freddie, they're talking to the Fed. And so I have this wonderful resource to kind of say, okay, well, this is how we're getting through it. This is what we can expect. This is how we're making progress, and really the messaging that I'm getting is that, which I totally agree with, is that this is a temporary situation, that there will be restrictions that mortgage companies are going to be putting out there to be able to survive is really what we're focusing on at this point in time from that standpoint. And then understanding that it's really about educating. It's really about, explaining to people, yes, this is a really great thing to do, this forbearance, if it's something that you really need to do. Like, I don't want to see people lose their homes, but this is not a free for all. And so, understand that there's a cost. And if everyone just says, oh, I'm just not going to make my mortgage payment, you don't know how they're going to require you to go ahead and make that up, because they will require you to make it up. You don't know how it's going to impact your credit. You don't know how it's going to prohibit you from doing something down the road that you may not think you need to do today, but you might need to do later on. All of those different types of things. So, I'm just trying to get out there to encourage people. It's like, use the safety net if you really, really need it. And if you don't really, really need it, don't think that this is a walk in the park, that you're not gonna really benefit yourself, and you're not gonna benefit the markets overall from that standpoint. So
what's happening with interest rates?
Great question.
I'm seeing a lot of realtors talk about interest rates, and at the beginning of March, man, you were seeing people post all the time about, I just locked my client in this, and I just did that, and whatever, right? You had said something last week that was really interesting, that interest rates were like as low as they had been on, I don't remember what the date was, but let's just pull out March 8th. And then the very next day it went up by like the most so what is that about? And
so on March 9th was the day that interest rates were the lowest that they'd ever been. You were good. Yeah, I'm really impressed. You remember that. That's awesome. March 10th, the interest rates jumped up 2%. So interest rates increased 2% within a 24-hour period.
March 8th, March 9th, they were what percent? What people were saying, like crazy. Like
I was looking at like 2.75, 2.625 and giving people credits.
And then 2 days later, or 24 hours later.
24 hours later.
You're looking at 4.75.
Yep.
So why did that happen?
It has to do with the Fed and buying. So the Fed is buying mortgage bonds to stimulate the stock market. Okay. So you have the stock market dropping. And so you have a lot of concern.
This is a geek out moment, by the way. This is your
geek out moment, right? So Here's the thing. Normally what happens is if when people are selling stocks, they're buying bonds because bonds represent security. Bonds represent a guaranteed return on your money. And so if you're freaking out about the world coming to hell in the handbasket and everything's falling apart, you want to go ahead and you want to put your money in a secure investment. The problem is that right now, no one wants to buy anything. Everyone wants their cash. So they're not buying stocks. They're not buying bonds. And so you saw the market start to crash and separate in ways that we had never seen before. And so what happened was that we saw the rates drop, and then the Fed had to step in. And the last 12 days have been a blur, let me tell you. But I'm not exactly sure what triggered that huge shift. It just happened. Like I seriously went in and said, I emailed my lock desk and I said, there's no way in hell this interest rate is now this much higher. And they said, yeah, it is. So what's been happening is the Fed is continuing to buy. They came out with a stimulus package. They talked about the forbearance issue. And what they really did at that point in time was they also said that they were going to be buying mortgage bonds. And that normally would stimulate the economy, right? And make things better. And what we tend to see is like every morning the Fed's coming out and buying $5 billion worth of our own debt, $50 billion, not $5 billion, $50 billion of our own debt. So we see rates better in the morning. And then when they spend all their money, rates get worse in the afternoon. So when we're talking about interest rates right now, they still are really great. I'm looking at putting in some clients on a conventional loan at like 3.375% on a 30-year fixed for a purchase.
Yeah,
which is great. That's a great interest rate.
Yeah.
What's happening on the refi side is the concern of all of these people refinancing, early payment, payoffs, things like that. And so we're not seeing that same traction there. But what I want to share with people is if you don't have to refinance right now, you don't need cash out, you can make your payment, you're okay. Interest rates are going to be low for a long, 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 long time. So if you can wait, you're going to get better interest rates in 60 to 90 days once they figure all of this out. Right now, they're really trying to not have refinances because the system is still over capacity.
Yeah.
It's not, you can't go down to Kelly. Yeah.
And so that's a question. So the system being over capacity, and this was somebody that somebody asked, so since we're on this topic of refinances, is there any concern that somebody who started the refinance process at the beginning of March is actually that they wouldn't be able to close on that refinance?
It depends on where. It's a hard question to answer. At this point in time, I'm going to say no. That I wouldn't be concerned about them because what people are doing, what the really smart people are doing, that's not me. Understand? I'm not the really smart person. I'm the person out in the front here to answer the questions.
You're very smart.
Yeah. So what the really smart people are doing is they're working on those warehouse lines and they're working with the government to go ahead and figure out how they can manage these margin calls that they're getting, which is, literally companies are writing checks for millions and millions of dollars. And when you're using a warehouse line, and what they're also trying to do is they're trying to stay away from warehouse lines like Wells Fargo or something like that, where there's so many overlays that it makes it super hard to fund your loan. So they're trying to stay with the warehouse lines of the direct Fannie Freddie warehouse lines, so that then we can keep things as simple as possible.
Okay.
We're locking loans for 60 days on refinances. Still doing purchases in 21, 30, as long as we don't have an appraisal issue or delay. Those purchases are taking precedence with every single lender because there's a contractual agreement. We need to keep the real estate market going. We're very aware of the fact that we have, very important relationships and we're a very symbiotic industries. And so we want to continue to support the real estate industry. That's balanced with, the people that come to us for refis are our past clients who like, know, and trust us. So I'm always kind of torn between the two. but we understand the contractual part. I would say, your refinances are going to take 60 days because you have so many, and we talked about this, in the first couple months of the year as a country, purchases and refinances, we closed about $200 billion, give or take some. In the first 12 days of March, there was $200 billion of loans locked. There are trillions of dollars of people who have equity in their home that have a little bit higher interest rates that are eligible for refinances. Okay. But right now,
I want to make sure we don't glaze over that. So up until March, from January 1st, let's say, to February, end of February, 29 days this year, there were $200 billion in refinances. With a B, billion.
$200 billion of purchase and refinances that closed in the first 2 months of the year.
And then from March 1st until March
9th or 10th,
there was $200 billion locked.
Correct.
Yeah. So, so put some perspective on there. That's a lot of money. And
that's a lot of money, and that's a lot of time. So you figure on average your loan amount is maybe $350, and you divide that into the $200 billion. It tells you how many loans were actually locked, which tells you how many loans these people have to process, underwrite, draw docs, fund. I mean, it's the mortgage industry is not one where you can go down to the neighborhood employment center and say, hey, I need to, do a temp hire on 3 or 4 underwriters. I mean, it takes these people 15, 20 years to become an underwriter. Yeah.
Yeah, you hope not.
Yeah.
Okay, so we're going on about 36 minutes. Wow, time flies when we're having fun, right?
Yeah.
I want to open this up. Anybody, if you have additional questions, we would love to tackle those. But let's just, for fun, real quick, have you seen Tiger King on Netflix?
I did watch it. I watched it. It was kind of like what it was. It was watching like a car wreck that you couldn't stop watching.
Yeah,
is that a fair way to describe it?
But it was like if a car wreck was mixed with a train wreck that was mixed, but then nobody got hurt, and then the person, I don't know, it was just crazy. So did Carroll, what do you think about Carroll Basket? Did she kill her husband and feed him to the tigers?
I think so. What do you think?
I think that's, I would love for people to chime in here, but I think so too. Now, do you think that they're going to do a season 2 here?
I hope not. And well,
no, there has to be.
So what my thing was that I was struggling with, well, first of all, aside from the fact that I just felt horrible for the animals, absolutely horrible for the animals. My thing is when you stop to think about it, they were filming a documentary, which was filming a reality show, which was filming a daily. So there was 3 film crews.
Yes.
Right. And supposedly the reality show footage all got lost. So what you have left is documentary footage of, because my daughter's a videographer, so I'm more aware of these types of things. And I called her and said, so how did they stop to think about it? How did they even get this show if it was not planned that they were doing the documentary of the reality show of it was just okay, so yeah.
And so then what was her thoughts on that? That this was the intention all along, or what?
She thought it was kind of interesting. They watched it. And she's it's kind of one of those things I stopped watching it and I'm just I was kind of just speechless. And of course, I watched it. So I started watching it way too late. So it's definitely one of those things you can't, you have to have your 6 full hours. It has to go straight through.
Yeah.
So yeah, it was very interesting. I'm still not entirely sure how I feel about it.
I just think that it will continue to be that car accident that we're just what's going to happen next? We're just watching for what's going to happen next.
Yeah.
So, Lisa, what should we expect to happen with this crazy world, the mortgage and loan
I
world.
can't believe you're asking me to do a prediction. I'm
What's
just
your
like,
prediction for the next 30 days?
the next 30 days, I think, are going to be, you're going to continue to see purchases go well. I think that there's going to be great rates available for purchases. I think that this is actually a really amazing time for us to, it almost feels like a little bit like a chance to have kind of like some downtime. From a refinance standpoint, if you don't need to refinance, my recommendation is to wait 60 to 90 days. If it's not something that you need to do to survive, or it's not something that you absolutely need to do, I think you're gonna see better pricing in that 60 to 90 days in regards to refinances and stuff like that. So I don't feel like you've missed the boat. What we're doing for our clients is, we're just kind of getting them prepared. If they don't need to pull the trigger right now, then maybe it's, we can wait. If it does make sense, because we do get some little like dips. So we're just kind of keeping our eye on dips for them. And if I see a dip that makes it make sense, then we'll go ahead and we'll grab it. But if you end up waiting 60 to 90 days, I don't think you've missed the boat. From that standpoint, I think right now, from a realtor standpoint, is that there's a lot of opportunity here. One of the things is that, what we do is so relationship based, right? And so, right now it's not about picking up the phone and calling someone and saying, hey, do you need to buy or sell your house? Right now, it's about this beautiful piece that I feel has kind of come out of all of this, because in great pain and struggle, there's always beauty. It's kind of like taking that pressure and you create that diamond. Pick up the phone and call your clients and just ask them how they're doing. Spend an afternoon on the couch FaceTiming your clients and checking in with them, making those types of connections. I know that I've had a couple realtors say, well, what do I say to them? Right? How do I'm not calling to sell them, and I want to call and check in on them and stuff like that. But what happens if they start asking me questions? I'm like, well, then let's get some basic, figure out what questions you think the clients are going to be asking you. And then let's get some simple basic facts for you to be able to have that conversation with them. Let's get your comfort level to that point, and then make those phone calls and just check on your people. Check on the people that, you can, because at some point in time, not that this is why you're doing it, but at some point in time, it's like taking that time to care for our fellow human beings. I was watching I'm doing a lot of opportunities to just kind of, it's about mindset, because I hate working at home. This is the most, I did not think that this was going to be like that. Aside from the sweatpants that I've worn for the last 4 days that you don't get to see, this has been like really hard for me. I don't like, because then it's like it never separates. Like, it's right here. It's on my dining room table. And so it's always right there. So I've been doing a lot to try to keep my mindset in the right place. And so I was watching this great video, and I just wanted to share it really quickly with you. There are basically 4 archetypes that we have. We have the victim, the hero, the villain, and that guy, right? And so what the victim is one that reacts to external forces and just says, this is happening to me. And then the villain, of course, is always seeking vengeance. So what can and of course, we all have these people inside of us. We all have these archetypes inside of us. And so what can I do every day to try to spend as much time as possible in the hero mindset and the guy mindset, which is really kind of helping the hero win. And so the hero piece is always about responding and rising up to the challenge, right? Mm-hmm. That we don't change or we don't grow when we're comfortable. And everybody's uncomfortable at this point in time. So we can either look at it from a standpoint of, oh my gosh, my life is out of control and it's scary. And it is all those things. Like, I think that we're all experiencing that to some degree. It's all, all of us are feeling that way to some degree at some different points in time during the day. But under this, there's also an opportunity to be called to become the best possible version of ourselves. And it's how we try to rise up and stay focused on the positive and be that guy who's out there thinking about others. I tell my kids, it's like, yeah, life can be hard, but sometimes it's just taking the simple act of trying to do something nice for someone every single day. right? With no expectation of a response, no expectation of something coming back. It's just like, wow, like I was thinking of this person. You just pick up the phone and call them and just say, hey, I was just thinking about you. How are you doing? Are you okay? Like, I can't really come help you because I can't leave my house, and we want to be very respectful of that because we're trying to do, everyone's trying to do everything that they can to kind of flatten the curve as quickly as possible. But it's, do you just need someone to talk to? Do you, can I send you a bouquet of flowers? I mean, just little things that we can all do to help each other out. I think is possibly one of the most interesting and unintended opportunities and consequences that we may see from this. And I hope that if we all kind of can operate from that standpoint, that when this is all done, that we still keep that piece, that we've learned these lessons and we've learned to get over some of our fears, of like doing video or something like that, because we've now been forced to do that, right? To stay connected. We now have to play with Zoom and we have to do all this type of stuff. And so I think that there's a lot of hidden opportunity here that is kind of revealing itself. And if we stay focused on it, then hopefully everything will be better as a result.
Yeah. I think over the next 30 days.
I'm done. I'm getting off my
Yeah, preach. Mic drop. Right.
Yeah, there you go.
I think when we come out the other side of this, that there will be people who found the opportunity and found the good in this whole situation, and their businesses and their lives and them just in general will be better and more fulfilled and full.
Right.
So we're at about 46 minutes. Thank you everybody for watching. Thank you, Lisa.
You're so welcome.
If you're still watching, I wanted to plug, so on this Friday, April 3rd, the Women's Council of Realtors, Northern Nevada, they are doing a special event with Jason Abrams. So it's going to be a live Zoom call, and you can check it out. I know Nevada Home Connections and Ticor Title were teaming up to put this together. I know Claire Kirby worked really hard on it. So I'm going to be there. It's, again, this Friday, April 3rd at 9:45, and I will post here later for everybody to see.
That's awesome. That's awesome.
And I hope you can be there too. So Lisa, thank you again.
You're welcome.
For geeking out with us on the loan and mortgage industry. I know sometimes it can be a dry conversation, but I think it's very important for people to know what's going on and how they can stay in the know for their clients.
Yeah. That's awesome. Oh, I just saw that Axia apparently still doing jumbo loans, so that's a great place to go. So it looks like Axia hasn't shut some stuff down yet, and so hopefully they'll still be up and running and doing that throughout the whole process. So that looks like a great option for you there. And then I do want to talk to you offline. There was a couple of different ideas that I had that I wanted to share with you. So maybe we can we'll talk afterwards. But
okay, everybody, we are going to talk afterwards. Thank you for everybody. Thanks for watching. We'll see you next week. Appreciate you. Bye.
All right, thanks, Jared. Bye-bye.